Welcome back to Halftime Report on CNBC TV18. Obviously, we've seen a bit of a recovery coming in the market as well. So that is what we'll watch out for. 23,750 around that level is what the Nifty continues to trade at as of now. So we'll watch out for where it's going to go in the second half of the trading session. But let's talk about another earnings candidate that we have today. KPIL Projects, they reported their numbers, strong numbers that came in from the company in terms of growth. Profitability has seen an improvement, strong order book that stands for the company as well. Improvement in terms of the balance sheet. Net working capital days have seen an improvement as well. So to discuss the outlook of the company going forward, we are joined by Amit Upalenchwar, Director at KPIL Projects, to discuss the way forward for the company. Amit, good afternoon. Thank you so much for joining us on the show. First up, let's talk about your revenue, right? You all had the con call this morning as well. FY26 strong 20+% growth in terms of revenues. You've given a guidance of 15% for FY27. Apart from Middle East concerns, are there any concerns in terms of the revenue risk that comes in? And also, what are the segments maybe that are going to do well for the company in terms of opportunity that lies ahead? Any new segments maybe that you all are looking at?
So, we said that we'll do in excess of 20% last year. And we were quite happy at a console level. We did cross 22% in terms of revenue growth. Going forward, if you see the last 5-year CAGR for us on revenue has been around 16%. And we are cautious when we say we'll do 15% next year because there's a lot of disruption, not just in the Middle East. Also, there's impact of that in India. And for us to scale responsibly means we also need to add management bandwidth so that our balance sheet is not impaired in any way whatsoever, and our margins are not compromised. So if we are able to grow at 15% next year at a scale where we already are, and if you look at our 22,000 crore number where we closed at last year, we should be crossing 30,000 crores. And I think that's what we look at. Instead of looking newer places, we are building capability in several new areas like battery storage, hydrogen, nuclear sector from an EPC standpoint. But what we want to do is take some of our other businesses overseas, like water. We are seeing massive opportunity in the Middle East, be it desal, be it STPs, etc. We want to take our urban infra division overseas. We are seeing a lot of opportunity in reconstruction works in some of the developed economies close to Europe. Plus, we are seeing metro projects coming. So that's something. Airport projects is something that we are tracking overseas. So far as our BUs that are concerned, and I think transmission and distribution business, our building and factories division, industrials business, oil and gas, and urban infra, which we see, growing and contributing to this 15%, we are going to be cautious on our railway business in terms of growth. And hopefully water starts to show green shoots in terms of EPC business overseas this year.
Absolutely hoping for that. But, Amit, just want to clear out the points on the Middle East front, right? Middle East is around 9% of your order book that stands as of now in terms of geography, right? So just to get it clear, one, is there any impact in terms of margins that one could see coming in Q1 FY27 because of the Middle East issues? What is that? What are your contracts like? Is it fixed or variable over there? Is there a possibility of pass-through? And has the work now restarted in Middle East? Was there any concern on that front?
So to start with your last question first, we've not had any stoppage of work in the Middle East on the 8-9% order book that we have. So construction goes on. Yes, there have been for safety concerns where maybe a day or two that we stopped work, but there was no stoppage of work as such. So there was no hit in terms of our margins. Yes, there were certain supply chain issues which caused deliveries to be, postponed last year. And hence you see a little drop in our Q4 revenue growth was primarily because, we lost 200-300 crores of revenue due to supply chain issues. But I don't see any margin dent whatsoever in that 8% order book because of these disruptions at all going forward.
Sure. Amit, what about overall margins for FY27 as well? You said you're focusing on T&D, building and factories, oil and gas, all of that is doing well. That's where the trend is. So that is better margins. So does that lead to more and further room for margin improvement from here on?
So most certainly, we are thinking of doing at least 75 bips of margin improvement going forward this year. This is already coming at the back of a significant margin improvement in the last two financial years. So I think by getting our margin 75 basis points to 80 basis points in the current financial year will be a good achievement for us at at KPIL level.
Okay, some further improvement in terms of margins. This time also your PBT margins have been very good and strong as well. And further improvement there is what we could see. Also just about transformers, there's a lot of word going around that there are transformer shortage. Anything on ground that you could help us understand what is the current situation?
So I think, yes, there is in general in the T&D space, there is across all suppliers, their factories are booked out for the next 2 to 3 years because of a sheer surge in the number of orders that are coming. But I think from our perspective, we are looking at the high end of the T&D segment, which is the 765 kV or the 800, HVDC lines. And in that, of course, the transformers either acquired by the client for us being both or the government or private sector, and there are strategic alliances that they have. So I don't see that as a challenge for us per se. But yes, smaller rated transformers could be a problem but that's not the segment that we are looking at,
Okay.
200 kV, etc. in India. So I'm not overtly worried.
Okay. Just quickly, water, what is the current situation in terms of that, the collections? We've spoken about in the past as well. You did touch upon it a bit. But by when do you see this maybe completely going off, the collections coming in as well? First half of the FY27, is that expectable?
So what we hear is close to, towards the end of H1, we still have 1800 crores to collect, because of which we've also had, no growth in our water business last year. Otherwise, we would have had even more revenue growth. We were very, very cautious that we will not do growth in the water business at the cost of denting our balance sheet. There have been collections in the last quarter of last year and also in in the April month of this year. So we are hoping that, by end of H1, we should have our monies collected and throughout the full year, most certainly. And then we start looking at water projects more outside of India other than just looking at India as a market as we did over the last couple of years.
Okay, Amit, thank you so much for joining us this afternoon and taking us through the outlook of the company. A lot of opportunities that come in on the EPC side for HVDC, new segments, and the segments you're already on, working more on that as well. Data centers as an opportunity also for y'all. So, Amit, thank you so much for joining in. But on that note, we're going to step into a very short break. On the other side,